Risk and return, what really matters. Normally these opening slides give you an outline of what's going to happen in the video. And then while that's true, this outline actually tells a story. So let's go through it. This video will reveal an important shortfall in modern portfolio theory. We covered modern portfolio theory in a previous video on diversification. We'll relate unexpected returns to total risk and then equate total risk to the sum of systematic and unsystematic risk, something you've seen before and we've talked about. We'll also equate total risk to the sum of diversifiable risk and undiversifiable risk, something that you also have seen before. We'll assume that diversification is costless, which is not a bad assumption, and then ask why anyone would want to bear diversifiable risk if it costs nothing to get rid of it. And from these arguments, we'll deduce that investors should only earn a return as the result of taking undiversifiable or systematic risk. Furthermore, we'll argue that beta is the appropriate measure of undiversifiable risk, in other words, systematic risk. We'll derive the CAPM, since the CAPM employs beta, and we'll consider its implications and assumptions. We'll show why covariance relative to the market portfolio, like the S&P 500, is the only risk that should matter to investors. So I'm going to start off the first part of this video by justifying the use of beta and the capital asset pricing model. So let me start off with something that we overlooked in the last video under diversification. In that video, we talked about modern portfolio theory. And the modern portfolio theory, was the efficient frontier we talked about, and it was also the idea that, look, if you have stocks that covary, let's just say we have stocks that are perfectly negatively covary, and we have return here and we have time here, right? Well, the average goes right down the middle, so that's the average return, right, for this portfolio. So put our bar there. Now notice, and I didn't really put any numbers to this when I was doing it graphically in the previous video, is that this could be 10%. And you say, well, okay, you get a portfolio return that doesn't have any risk because it doesn't vary because one offsets the other. That's as best I can draw it. And so we have a portfolio with no risk that earns 10%. Well, that should kind of be a little disconcerting to you, because what if you have a T-bill over time that's a 1% rate of return? Well, a T-bill is risk-free. This is risk-free. How can you have two risk-free assets with two very different returns? If that was the case in a real economy, in real financial markets, people would buy this return, so to speak, the combination of these two stocks, and sell this return to make some profit. In fact, nobody would want to be in this particular security, the risk-free. Now, you can always look at this from the fact that, these are risky securities and you never know this is really going to happen, that you can get are perfectly negatively correlated stocks. But still, the theory is a little disconcerting because it seems to have a hole in it. How can you have this and this, even within a theory? And so that leads us to looking for alternative ways of trying to look at the market and how to what we call price stocks. What determines the return on a stock? That's what we mean by pricing stocks. So when we look at the capital asset pricing model, it's really about what drives returns. So the word pricing is a little misleading in the label. So let's continue here. First off, let's start off with things that we're familiar with, and we'll lead up to trying to justify the capital asset pricing model. First off, we have U here. U equals, we'll define U as an unexpected return. And that's your actual return minus your expected return. We often use this as R bar. So basically, under a normal distribution, this is your average. This is what you would expect to see. And that's what we mean here. So we would have unexpected returns or deviations from this mean. We captured that when we used standard deviation, or just sigma. And that was the sum of these unexpected things, right here, the unexpected component averaged out. So we captured this, and we took the square root, by the way, to get the sigma, just sigma without the squared. So what we did here was, look, we're looking at a particular stock over time, and we're looking at, and this would be our bar, we're looking at the deviations over time as being risk, because if you expect this and you get this, that's risk. And even if you get risk, even if you end up getting this, that's risk, because it's a symmetric distribution. And so if you can go down a lot, you can go up a lot. And so that's the thought process there. So standard deviation captures total risk associated with a stock. So here's the return, here's what's expected. This is a measure of total risk. It's consistent with this story. We looked at risk on this sliding graph, and we said, look, this is the number of securities in a portfolio. This is total risk. And that total risk is equal to systemic risk plus unsystemic risk. Systematic risk plus unsystematic risk. And when we looked at this graph, what we were saying was, look, you can get rid of a lot of this risk, this idiosyncratic company-specific unsystematic risk. Get rid of it by holding a large portfolio. And the large portfolio eventually becomes the market. You eventually hold a piece of all the securities in the market. And that's what we were talking about. Well, you can go further and look at this from a couple of different angles. You can say, look, this is, and we know this is systematic component is the undiversifiable risk that's out there. And the unsystematic is what can be diversified away. Two different ways of looking at the same thing. But now we're going to go a step further, and we're going to say, look, why would anyone want to hold a small undiversified portfolio? Say here, a few stocks where you have a substantial amount of risk, and much of it is this diversifiable risk that you can get rid of. If we assume that you can diversify risklessly, then why would anybody want to hold this risk if they could be out here with a well-diversified portfolio and still keep up their expected return? So remember, in the Markowitz stuff, where we did basically modern portfolio theory, we had return, we had risk, and we moved in this direction. A whole bunch of individual stocks were here. And while we were discussing this, we said, look, this is basically the market portfolio, and that's the most efficient portfolio from a risk and return perspective. Why don't we hold this market portfolio? And given the fact that diversification is free, that's what we're assuming. And by the way, that's not a bad assumption in today's world, because as you've seen in StockTrack and all our discussions, you can buy, for example, the SPY in one click with a commission that's really low. So you don't have to worry about the cost, so much the costs of diversification. It's relatively free. And so it justifies the fact that, we should be holding this market portfolio. And the question becomes, why would we want to hold diversifiable risk if it's costless to get rid of it? That is more support for the idea that we should be moving and holding this market portfolio. So with that logic, you come to the conclusion that, okay, we should hold the market portfolio, but then again, how do we price risk? How do we determine the expected return on an individual stock and portfolios? And we come to the conclusion, and I'm going to show you some support for it in a second, that we should be pricing stocks relative to the market. And then the question becomes, well, what do you mean by relative to the market? And that's what I'm going to hit on next. That's what I'm going to tackle next, is how do you price a stock relative to the market? So let's clean this up. And let's look at the risk of a portfolio. We know that the risk of a portfolio is the weight we have in X squared times the variance of X for each security. And then we have a whole bunch of covariance terms where we have, remember, 2 times XA, XB times the covariance between the return of A and the return of B. And we have a whole bunch of those, right? So let's look at a really big portfolio. So not just A, B, and C. There's also D and E and all. And so you have a whole bunch of covariance terms. What we want to ask ourselves here is, what happens when we add more and more stocks to the portfolio? What happens when n goes to infinity, let's say? Well, there's not an infinite number of stocks in the market. Let's just assume that there is for a moment. We're sliding down this graph and we're moving in this direction. What happens to this calculation? That's what we want to get at. So when we do this, what becomes more important? Does the variances become important? Do the covariances become important, or a combination of all these variances and the covariances? What's important? Well, let's look at that. First off, if you have a portfolio with n stocks, each one of these weights, let's say we equally weight all these stocks, then each weight is 1 over n squared for all this. Right, each one of these x's. And so we're going to have n of these. So if we have n stocks, we're going to have n times 1 over n squared variances. Okay, for say individual stock I. And what happens is this becomes 1 over n times sigma squared I. And as n goes to infinity, right, this goes to 0 as n gets really big here. So this whole term washes out. Woo! That's really important. What it means is all these variances are insignificant when you get a really big portfolio. Okay, what that leaves us is, well, what about all these covariance terms? Ooh, there's a lot of covariance terms, and how do you handle that when n goes to infinity? Well, let's take a stab at it. One way to do it is, let's look at a matrix. Let's just look at 3 stocks, and you can use your imagination for going higher. We're going to put our weight 1 over n in the standard deviation of A. Okay, so we're going to look at 1 over n standard deviation of B and 1 over n standard deviation of C. So we're putting a weight, the weights that we were talking about, right, times the standard deviation that we have in each stock. And we're going to multiply these together, form a matrix. It's a little abstract, but it actually has a lot of intuition. So bear with me. If we were to multiply these out, we'd get 1 over n squared times the variance of A, 1 over n squared times the variance of B, and 1 over n squared times the variance of C. This guy is the main diagonal. That's what these guys are. And what we're saying is this doesn't count. This goes to 0. Now we have to look at all these covariance terms. We know there's 6 covariance terms. Okay, so remember that 2 was that between A and B, right here, this A and B is the same as this A and B. So these two are the same, these two are the same, these two are the same. That's why the 2's are there. And what are these terms? What are these off diagonals? These are the covariances again. So this is 1 over n squared times the covariance between A and B, and this is 1 over n squared times the covariance of B to A, and so on. So you're going to have all these covariance terms. You're going to have n, which is 1, 2, 3, times n minus 1 covariance terms. Now where do you get the minus 1? Well, the minus 1 is this, the main diagonal. You're going to have 3 times n minus 1. You're going to have 6 covariance terms to deal with. 6 different, well, 6, I shouldn't say 6 different. You're going to get 6 covariance terms in total. So therefore, what you're going to have here is, for these 2, you're going to have n minus 1, and then you're going to have the weights, because each x is 1 over n, because we're putting an equal amount in each stock, times the covariance of the return of, say, stock I and the return of, say, stock J. And so what does this boil down to now? This n cancels with this n, and this becomes n minus 1 over n times the covariance of stock I to stock J, some covariance between 2 individual stocks. As n goes to infinity, this becomes 1. So you can ignore that. And what this all boils down to is, look, we just got rid of this, and we just said, look, everything boils down to covariance. So the sigma of a portfolio is related to this covariance of individual stocks. That's what we just boiled it down to. Somehow it links up with this covariance. All that matters is covariance. But covariance with what? Well, we just argued that we should be holding the market portfolio because we should be down here on that sliding graph of diversification. And we also said that, the efficient frontier, we should be moving in this direction, which is the market portfolio. Then what we should be doing is we should be looking at the covariance of stock I relative to the market. So it's a little bit of a leap, but it's not that far. It's not that much of a leap that we need to connect this to the market. So let's develop this a little bit further. So we're saying that the variance of a portfolio when n goes to infinity, that's an infinity sign by the way, is going to be the covariance of stock I's return relative to J's return. But now, like we said, we need to bench this relative to the market because people should be holding the market portfolio. So it's relative not just to another individual stock, J, say, but to the market. So it would be covariance of the return of stock I relative to the market, right? And if we want to scale this, because remember, covariance is unscaled because remember, covariance is the correlation between stock I and M times the variance of stock I times the variance of M. These variances could be, standard deviations could be anything, really, really big and wild. So why don't we scale that by the variance of the market? And when we do that, we call this beta for stock I. And what it is now is it's part of the security market line where we have beta here. We have the average stock has a beta of 1. So this is scaled. So the average stock has a beta of 1. We come up and over, and here's the expected return on the market, which has the average stock has a beta of 1, and the market has a beta of 1. And how do we know the market has a beta of 1? Well, I'll show you that in a minute or two. Remember, the security market line is the expected return on a portfolio equals the risk-free rate, which is here, plus beta for stock for this portfolio times the expected return on the market minus the risk-free rate. What I want to do now is I want to actually derive this because I haven't really shown how we got this formula. So far, I've just shown you how we get beta. But how does beta fit into this equation? How do we get this equation? That's what I want to do next. And we're going to develop it this way. Let's say we put together and we have a portfolio. And this should look kind of familiar. We're going to say we're going to put money between the risk-free and the market. And this is what we're going to do. It's going to look a little strange at first, but it won't. What this means is, look, see this X? This is how the weight that we're going to put in on the market portfolio. And it's reminiscent of this efficient frontier stuff that we looked at earlier, where you could put some of your money in the market, some of the in the risk-free asset, and you could be somewhere in between here. Well, that's what we're doing, except we're doing it mathematically, and we're saying, look, this is the weight. This is the percentage of your money that you're putting in the market. And then we're forcing the weights to add to 1. So when you say 1 minus X plus X, well, that has to equal 1. So I'm forcing the weights to equal 1. So all we have is a portfolio between the risk-free and the market. That's what we did over here. But we're going to go further. Let's look at the beta of this portfolio. And so the weight that we have in the market here is the beta of the risk-free plus the weight that we have in the market times the beta of the market. So if we look at this carefully, we know that the beta of the risk-free asset, it's got to be 0, because the risk-free asset doesn't covary with anything. Because the risk-free asset's a straight line, there's no covariance there. Remember that story? So basically what we have is XM, using this equation right here, XM equals the beta of the portfolio divided by the beta of the market. Let's plug this into here and here. And what we can do is we're going to now determine how the expected return on this portfolio is going to work. And that's going to equal 1 over beta P beta M times the risk-free plus beta P beta M times the return on the market. Now simplify this. Basically, simplify this and spell it out here. You get the expected return on a portfolio is the risk-free return plus this market risk premium times the amount of risk that you're taking, this portfolio, the amount of risk that this portfolio is taking relative to the market. See that? Divided by the market. And dividing by the market is not such a problem because we know that the beta of the market, okay, the beta of the market is going to be 1 by definition. How do we know that? Because the covariance of the return on the market relative to the market. How does the market covary relative to itself? You know, it's the correlation of the market relative to the market times the standard deviation of the market times the standard deviation of the market divided by the variance of the market, right? And so again, that's a scaling thing. And so what happens is this cancels out and this correlation is just 1. How does something covary with itself? How is it correlated with itself? It's just 1. So this whole thing comes down to this. This should be variance. It all comes down to 1. So the beta of the market is 1. So when we look at the security market line, we have beta. We anchor here that the average stock has a beta of 1. And here's the expected return. And so here's the expected return on the market right here, given market risk. And so you're going to have some stocks that are more risky, some stocks that are less risky. But they tend to be positively correlated with the market. It's possible to have negatively correlated stocks and be down here, but we tend not to focus in on that. That's possible, but much of the action is right up here. Positive correlation with the market. And so when we do this, then we have the expected return on the portfolio equals the risk-free rate plus the beta of your portfolio and the return on the times the return on the market minus the risk-free rate. That's the market risk premium. And so this applies to a portfolio that's a combination of the market plus a risk-free rate. But it also applies, this whole formula also applies to individual stocks. So what's the expected return on individual stock I? Well, it's the risk-free rate plus the beta of stock I times the return on the market minus the risk-free rate. And so what we're saying here is, look, the expected return on a stock, individual stock I, or the market, or any portfolio, is a function of its beta relative to the market itself. And so what we're saying is this formula applies to individual stocks and the market as a whole, and any portfolio. And it's founded off the idea that you should not be holding small portfolios. You should be only holding diversified portfolios. And what these betas are capturing is systemic risk only. These betas capture only systemic risk because that's all you should bear. Because as we said before, we assume it's costless to diversify. So why bear a lot of unsystematic risk? You shouldn't be bearing it. You should just be bearing systemic risk because that's the risk you can't get rid of. And if that's the case, then now your expected returns should follow this type of equation. the opportunity cost of money, and then a measure for risk. And if there's no risk, what if we put the beta of a T-bill in here? Well, the beta of a T-bill is 0. So what do you get? Your expected return on your portfolio is the risk-free rate. So now, before we move on to problems, we've got one more idea to cover, one more concept that's important, and that we can relate back to StockTrack. Let's derive it. So we have an expected return on a portfolio equals 1 minus the weight we put in the stock X, or portfolio X. Just call it portfolio X or stock X. And it's going to look like this, the expected return. It's the math we saw earlier. But here we're just saying, look, this is stock X, or it even could be a portfolio X. So the expected return is nothing but a weighted average of the risk-free and this portfolio and this stock X. So that's our portfolio. Now the beta of this portfolio is 1 minus the weight that we have in the beta of the risk-free plus the beta of stock X weighted by X. We know this is 0, and recall that we said X of X, the weight for stock X or portfolio X, is the beta of our portfolio divided by the beta of X. And we plug this in here. And we get an expected return on the portfolio is 1 minus the beta P, beta X, risk-free, plus beta P, beta X, expected return on stock X or portfolio X. And when we rearrange this, we get the risk-free rate plus the beta of the portfolio, the relative or scaled to this portfolio or stock X, to the expected return of stock X relative to the risk-free rate. Okay, so that looks very familiar. Except now, instead of the market, we're just looking at an individual stock X or a portfolio. And what we want to do is let's look at the change in this expected return of this portfolio for change in the systemic risk of this portfolio. That's what that stands for. This is sometimes called the reward to risk ratio. See, the top part is the reward, the change in your reward, the amount of return you're getting versus risk. So it's sometimes called the risk to reward ratio. That ratio turns out to be the expected return on X minus the risk-free rate divided by the beta of X. So there's the reward. That's basically a risk premium for stock X or portfolio X divided by the risk associated, the systemic risk associated with X. So this is the reward to risk ratio, and it has some really cool implications. It says, look, all stocks and all portfolios that are well diversified, because we're measuring risk in terms of systemic risk, all stocks before the fact should have the same reward to risk ratio. So that the reward to risk ratio for stock X should equal this, and that should be the same as the ratio for stock Y or portfolio Y, and the same as stock Z or portfolio Z. What that means is, before the fact, ex ante, the attractiveness of stock X, Y, and Z are all the same. Any stocks you pick out of the market or any portfolios, so this is stock X, this could be an ETF, an exchange traded fund, or some type of mutual fund. All of these securities all have the same risk and return trade-off. They're all equally attractive before the fact. So when you start up your StockTrack portfolio and you're looking at, what do I invest in theory, everything is equal because supply equals demand for stocks, and the price adjusts accordingly based on supply and demand. So the price adjusts accordingly to supply and demand, and the information that's out there in the marketplace. Remember the efficient market hypothesis that all stocks reflect relevant information. Well, prices change to reflect that relevant information at any given point in time. It doesn't matter what stocks you're looking at or what portfolios you're looking at. They're all priced to have the same reward to risk ratio. What is that reward to risk ratio? That reward to risk ratio is the slope of the security market line. So here we have beta, risk-free rate, expected return on your portfolio, and you're somewhere on this constant positively sloped line. So you put in, here's beta of X, here's the expected return of X, and you're right here at this point. And so from here to here is the reward given the level of risk here. So according to a lot of what we've done so far this semester in this course, is we've shown, at least from a theoretical point of view, that all stocks are basically equal at this point in time. If the stock market's open, let's say the stock market's open, it's 2 o'clock in the afternoon, all stocks and all those prices all reflect the fact that they all have equal reward to risk ratios. So there's more implications to stock track. Let me show you. So here we have the expected return on stock X or portfolio X relative to its systemic risk of X. Now just hold that thought and let's compare it to this formula, which should look familiar. Yeah, this formula, that's the Sharpe ratio. That's the risk-adjusted return calculation that we looked at way back in Chapter 1, and this is how students are ranked in StockTrack. This was the Sharpe ratio, risk-adjusted returns. But so is this. So why are we ranking on this instead of this reward to risk ratio? Well, because many students did not have a diversified portfolio throughout the semester, and so this is applicable to undiversified portfolios and diversified portfolios, where this is applicable to just fully diversified portfolios, as if you put all your money in the stock market, the entire market, immediately, instead of stock by stock and simply assembling undiversified portfolios. This is an important idea. Let me make sure we have it right here. So think about it. We have this graph where we have number of securities and we have risk, and this measures total risk. If you have well-diversified portfolios, you're out here, and all that counts is systemic risk, systematic risk, right there. That's it. All this is gone. So if you have well-diversified portfolios, this is the appropriate measure. But what if you have undiversified portfolios and you're here? Well, there you go. See this guy right here? It's appropriate there. Beta is appropriate as you get further out here, and as your number of securities goes up. In other words, evaluating portfolios that are here with simply beta, measuring systematic risk, is very misleading, because you've got a lot of other risk there, idiosyncratic company-specific risk. So now the question becomes, how do we interpret these ratios? This ratio is interpreted as the risk premium per unit of systemic risk, systematic risk. And this is measured as a risk premium per unit of total risk. That's how you interpret it. Now, one more thing, one more loose end to tie up before we start working on some problems. Back to this slide right here. We have the risk to reward ratio for X, Y, and Z, either stocks or portfolios. And notice that things have changed a little bit compared to what we did in the previous video, where we discussed the market portfolio as being the optimal portfolio. The security market line is still here. It still runs through the market portfolio as being an efficient portfolio, but now we're relaxing for that assumption that the market portfolio is the best, most optimal portfolio. Now what we're saying is, look, if you're on this line, like each one of these relationships are showing, then you're pricing as a function of the market, and you're still efficient here. You're still efficient on this security market line. So just that you're pricing your risk and your reward relative to the market as a whole. So the market is still an important portfolio. Now let's move to a couple of examples. Consider the following information. We got two stocks I and J, we got the standard deviation, and we have the betas listed. Which stock has the greater total risk? Well, it's going to be stock J, because stock J has the highest standard deviation. Which stock has the greater systematic risk? Well, it's going to be the stock with the higher beta, and that's stock I. Question C, which stock has a greater unsystematic risk? Well, stock J has the highest total, and it has a small amount of systematic risk, so the difference has to be unsystematic risk. So the answer to C, question C, is stock J. Question D, if you held a well-diversified portfolio, which stock is more risky? The stock with the higher beta, which is stock I. Question E, if you had only a one-stock portfolio, which stock would be the least risky? Well, if you have a one-stock portfolio, it's total risk that matters because you don't have a diversified portfolio. So you want to look at total risk, which is standard deviation. So which stock has the least risk? Stock I, because it only has a 9% standard deviation. Will the expected return on stock I vary depending on whether it's held in a well-diversified portfolio or held alone? Absolutely not. I mean, think about it. Stock I, any stock, could be held by multiple people. And some people will have diversified portfolios and others will not. The expected return won't depend on who has what investment. The expected return is going to be a function of the market risk premium, the beta of the stock, and how it co-varies with the market according to the capital asset pricing model and the security market line. Okay, let's look at another example. Assume you are a well-diversified investor considering the following two stocks, X and Y. Assume that the risk-free rate's 2% and the expected return on the market's 12%. So here we have the beta and the expected return for stock X and Y and a series of questions. The first one says verify the expected returns are correct. So I'm going to have to do some math. And then, there's other computations, and then I'm going to have to graph. So I'm going to move over to paper and pencil. Okay, so here I've copied over some of the information, and the first question is verify the expected returns. In other words, are they correct? Well, the expected return of X is going to equal the risk-free rate plus its beta times the market risk premium, and that should equal 19.5, and yep, it matches. Do the same calculation for Y, and you'll get the 8%. And notice that you got X, you got Y. Everything's the same in terms of this equation is for the security market line, except the beta changes for each stock because the quantity of systematic risk is different for each stock. But the market risk premium, look, it's the market risk premium. And the risk-free rate is the risk-free rate. Applies to all stocks. Now, the next question says compute the expected return and risk on a portfolio of X and Y, assuming 75% of your money is in X, which means or implies that 25% has to be in Y. So this will be 7.75 times 19.5, 0.25 times 8, and we're going to get a portfolio return that we expect to be 16.625%. And the beta of the portfolio, and before we actually calculate the beta, we need to ask ourselves, so the question asks, compute the expected return and risk. It doesn't say what type of risk. So when you see something that says compute the risk, first off, ask yourself which risk. Is it a beta, meaning just systematic risk, or is it total risk using standard deviation? Well, the problem tells us that these are part of a well-diversified portfolio, or being considered to be added to a well-diversified portfolio because this investor is well-diversified. That screams beta. So if I was to give you the same problem and I have a bunch of standard deviations here and correlations and so on, you would disregard that information and calculate beta. Now, if I said, look, this is going to be added, this will be a 1 or 2 stock portfolio of X and Y, then you'd want to calculate the total risk, the standard deviation. But we don't have that information here. But I'm just letting you know that be wary when you see a question that vaguely asks you, compute the risk, you need to ask what risk. Okay, so now The beta of a portfolio is simply a weighted average of the betas of the stocks in the portfolio. I've been using this formula, basically, the beta of a portfolio. So in the past, earlier in this video, when I looked at, what if we put some money in the risk-free? What if we put it in portfolio X? And I was calculating the beta as a weighted average. So that's pretty straightforward. And that's going to be 1.4625 as a beta. Don't put a percent behind here because beta is not a percent. Now the next question is compute the reward to risk ratio for X and Y in the portfolio and interpret. Okay, let's see what happens here. This will be 19.5 minus 2. This will be for X now. Divided by the beta, which for X, which is 1.75. So that's 17.5% divided by 1.75. That is a reward to risk ratio of 10. So for every unit of systemic risk you take, you get 10% risk premium. See, this top part is a risk premium for stock X. And so every unit of systematic risk, you get 10 units or 10% risk premium. And let's see, does it hold for stock Y? So here's stock Y. Well, let's see. 8 minus 2, which is 6%, divided by 0.6. Yeah, that equals 10. So things are looking good here. It seems like the market's in equilibrium, which I'll talk a little bit more about in a second. And then here's the portfolio. Portfolio 16.625 minus 2 divided by 1.4625. Again, that's 10. Ooh, everything's lining up. And think about it. It should be that way. Because every stock at this point in time looks equal from an investor's perspective. They all have the same reward to risk ratio at this point in time. They're equally attractive. Let's do a hypothetical here for a second and see why that is. We can delve deeper into this idea. What happens if stock X had a 15 reward to risk ratio? This was 15%. And this is a percent. You can put a percent sign behind it. Let's say it's 15%. What does that mean for this equilibrium? Well, it means the market's out of equilibrium. They don't equal. But why? Well, if this has a 15% reward to risk ratio, this is an attractive stock. X is attractive. People will buy it, push the price up. And when you push the price up, the return to whoever buys it goes down. And so that will push this closer to 10, right, in the direction of 10. But people will also, all else being equal, will be selling Y. They'll sell Y because that has a low reward to risk ratio. You sell Y, the price goes down and the expected return will go up. That'll force this to go a bit higher. So somewhere there'll be an equilibrium in between. So this will be bought, this will be sold. They'll equalize eventually. It may not be at 10, it may be at another number, but it'll eventually equalize along with the portfolio itself. Now the last part is let's graph the problem and interpret what that equilibrium meant. So let's draw it nice and big. So we have a security market line that's anchored at 2% and an expected return here and a beta here. First thing we want to do is put the market in there, because remember, the security market line goes through the market portfolio. So there must be a market portfolio M, and that has a beta of 1. We talked about that by definition, and according to the problem, it's 12% expected return. Then we have portfolio Y here, and portfolio Y, let's put it over here, get my geometry a little bit better, has a 8% expected return and a beta of 0.6. So this is Y, and then X is up here somewhere. X has 1.75, 19.5, and then we form a portfolio. And the portfolio is going to be right here at 1.4625 and a 16.625 expected return. Call that P. Everything lines up. Everything is a function of this portfolio. We're all on this straight line. So the slope of this line is 10. That's what the reward to risk ratio is telling us. It's saying, look, for stock X, here's the reward, 17.5%. And for stock X, this is the beta. So it's the rise over the run, this over this. 19.5 minus 2 divided by 1.75 is 10. That's the slope. That's the slope. Put it in percent there. And there you have it. Everything lines up. The market's in equilibrium. No stock is any better than any other stock at this point. And this video is finished.